USAA knows dynamic duos can save the day, like superheroes and sidekicks or auto and home insurance. With USAA, you can bundle your auto and home and save up to 10%. Learn more and get a quote at usaa.com/bundle. Restrictions apply.
Growing your e-commerce business comes with plenty of hurdles, but shipping shouldn't be one of them. Well, here's some good news. Powerful e-commerce shipping software called ShipExcel from Pitney Bowes. With ShipExcel, you can generate discounted shipping labels for both online and offline orders. That saves time and money with everything right at your fingertips. Start your free trial of ShipExcel from Pitney Bowes today.
Welcome back to The Bull, your personal finance podcast. This is an episode that hardly needs any introduction. Interviewing John Cochrane on a finance podcast is the perfect culmination of this long journey of nearly 240 episodes, which today peaks with a conversation with one of the most prominent figures in the academic finance world. Professor Cochrane is an undisputed authority on asset pricing, portfolio theory, as well as broader macroeconomic issues such as monetary and fiscal policy and inflation. Every second I spend talking is a second of attention taken away from the words of someone who deeply understands how financial markets work and the powerful forces that drive them. So, without further ado, I leave you to my conversation with Professor John Cochrane. Enjoy it! Professor Cochrane, welcome to my podcast, The Bull.
It's a great pleasure. Thank you.
It's a great honor to have you here. For those who don't know you yet, I can safely say that your name is the most authoritative one linked to the concept of asset pricing in academia. So we're going to talk a lot about how to price assets and what prices mean. I would like to start with a very hard question, which is, what is the stochastic discount factor? But I'm afraid a lot of people will disappear after a minute. So we'll try to cover the topic in a smoother way. The first question is, stock prices are the present value of future cash flows discounted by the market expected return. So this is the typical way to frame the question. But I feel that investors tend to focus more on the numerator, so the expected future earnings, while you made a point demonstrating that what changes is actually expected returns. This is the most important thing when thinking about how stocks will go in the future. Could you please expand on this concept?
Yeah. Well, I think we all understand that when interest rates go up, bond prices go down.
Totally.
Right? Well, that's actually a hard concept.
In 2022, we had a perfect understanding of the problem.
Yes. Now, when stock price goes up, there's two reasons that could be. One is that people widely see that there's going to be good earnings in the future. And I should qualify, when stock prices go up relative to earnings, dividends, and so forth. If earnings go up and earnings are expected to stay up, everybody understands why the stock price went up. Why does the stock price go up and there is no change in current earnings? Well, either people see future earnings are going to go up, or people are willing to hold a stock at a lower rate of return, much as a bond price goes up when people are willing to hold a bond at a lower interest rate. So those are always two possibilities. So then there's a question when you're accounting for historical and current variation in valuation measures, prices relative to earnings, dividends, book value, and so forth, which one is more important? And historically, it's turned out that the large-scale fluctuations, business cycle level fluctuations in prices relative to dividends, earnings, and so forth, have largely been accounted for by changes in return. We'll get to cause and effect in a second, but when prices have been high relative to dividends, earnings, and so forth, that has typically been followed by a period of disappointing returns. And prices have been low. That's been followed by a period of relatively good returns. I think I certainly wish I could go back to March of 2009 and buy everything. That's a classic example of a period in history when prices were low and it was followed by good returns. Actually, if you want to pick a moment, when you get a time machine, March of 1934, that's when you want to go. The stock
Best
market,
buying opportunity ever.
ever, exactly. In the U.S., not in Italy.
And now we typically invest with a huge exposure to the U.S. market, so it's fine.
Right. But back in 1934, that was
Sure.
So that's the historical fact. And now let's talk about cause and effect. You said something very interesting. You said investors focus more on the former, on the higher or lower expected cash flows. But I don't think that's true. Investing is always the balance of greed and fear. And investors do focus a lot on how much risk am I willing to take? There's the return I expect to earn, and there's the risk I'm willing to take. So times when markets have fallen, like 2008, 2009, I think are quite sensibly times when the average investor looks out and says, well, the world isn't ending and the stocks look like a great deal, but I can't take any risk right now. So they are, in fact, thinking in terms of what is the return I need to overcome my fear, to overcome my ability to take risk. And when that dominates, the price goes down or up. When prices are booming, prices are pretty high right now. What is the average investor thinking? Is the boom right now because, we all of a sudden, well, it might be this time, AI is going to come and triple everything. You never know. But it also might well be that prices are high when the average investor looks out and says, well, boy, these prices are pretty high. The returns going forward don't look so great. But what else am I going to do with my money? I can afford to take risks. The economy is doing pretty well. So it's perfectly sensible that people's balance of greed and fear would be driven by, in part, their feelings about, what risks can I take, what returns do I expect, and so forth.
Do you think that today, besides meme stocks and other fancy stuff like that, people think that these higher valuations are just fine because future earnings will be even better than now? Or because we are accustomed to thinking that investing in stocks is no longer that risky as we used to think 10 years ago?
Yeah, there's the things like the meme stocks. There's a bunch of stuff that is clearly nuts in markets. And there's situations where enthusiasts can jump on board, but it's very hard for other investors to short sell and to take the other part of that game. So that's why things like that can break out. Right now, I don't know what's in investors' heads, and I don't know if it matters what's in investors' heads. It matters what are they doing with their money. So they're certainly willing to hold stocks at pretty high valuations. I say that it is important what's in people's heads, of course, but you have to translate the language to map from the equations and concepts of how we think to what people talk about. So people may say, I'm buying stocks because I think the returns are going to be really good looking forward. Do they mean that? Or do they mean because I think the earnings are going to be really good looking forward and the returns might not be that great? And here's, I'll make a little bit of a technical joke. You survey investors when prices are high and they say, I think returns are going to be great. And you go, that's stupid. And our behavioral finance colleagues go, well, investors must be morons. Now you know the technical terms of behavioral finance. Maybe, but if you don't follow up that question by saying, is that the risk neutral measure or the true measure that you said the expectation? Now that's in finance theory, that's everything. Because prices are always discounted by the risk neutral measure. Exactly right. Now, if the investor goes, what the hell are you talking about? Then you aren't communicating well. You are interpreting his or her words into an equation, and you're doing the interpretation wrong. They may have been reporting the risk neutral measure, which would be completely sensible for them to do, and you're interpreting it as true measure and calling them a moron. So who knows what's in people's heads?
Sure, definitely. We can say that prices divided by dividends or valuations in general can tell us something about the changing discount rates. Two questions from here. Number one is, can we reliably forecast the long-term returns, starting from valuations, by saying, okay, today's valuations are very high, therefore long-term returns will be lower? And the second question will be the practical implication of that, but I'll come to that later after your answer to the first one.
Okay, yeah. This is the hard nut to swallow. When we look historically, it is true. All we know is that historically, on average, periods of high valuations have been followed by periods of low returns, not by periods of abnormally high growth. So, that's on average, and that's for the market as a whole. Individual stocks are much more driven by earnings news than discount rate news. The earnings news kind of washes out. So Ricardo's stock might be a high price earnings ratio. Cochrane stock might be low. That cross-sectional variation corresponds much more to people knowing your earnings are going to be good in the future and mine are going to be bad. It's the average when those earnings wash out. On the average, it's not true that the average stock market is high when average earnings are going to be high. It's mostly returns historically. Now, there's two big escape clauses here as far as forecasting. This time might be different. And that's exactly right. This time might be different. Irving Fisher said stocks are on a permanently higher plateau. He said that in 1929. He was wrong.
Worst call ever.
But he might have been right. So this is, in interpreting this phenomenon, there are also quite plausibly changes in very, very long run average returns that are not going to be forecast by these changes in prices. And you've heard, R star, long run real interest rates going down. Well, long run real interest rates going down permanently would be a permanent shift up in valuations. That would respond to the lower R star. It would say higher valuations because of lower return, but it's not a business cycle thing. It's just something that would sit up there forever. So in some sense of saying, yes, that high valuation could be a low return, but it wouldn't be a low return in the sense of we know the valuation ratio is going to come back down and you're going to make a really bad return. It's just going to mean you're going to earn 3%, not 5% for the rest of your life on stocks. That's possibility number one. And the same thing is true of the equity premium. This is a good story that in my grandfather's time, people who had to buy stocks had to buy individual stocks, and you couldn't buy across countries. So to buy stocks in the U.S., you had to buy, there's these pieces of paper that you went down to the safety deposit box. Now we can all hold internationally diversified portfolios, and many more people do. So the risks of stocks are more widely held, and that's permanent. I think it's great. It's wonderful. The average person can participate. Now, when the risk is more widely held, the risk premium goes down. So there's a story. These are two stories for, yes, the higher valuations correspond to lower returns, but not as bad as the regressions look. Because the regressions say that high valuation is going to reliably dive back down. Price earnings ratios will go back down to, 20. Price dividend ratios down to 20, from whatever they are now, 30 or so. That might not be true this time. We might be on a higher plateau. That's still lower returns, but it's not as bad as you think. The other problem is these long-run shifts. It is true statistically that if you look in the history, prices higher than average come back and prices lower than average come up. But what's the average? We only knew the average after the fact. Now, and Eva Welch at UCLA has made a big point about this. If you try to do this in real time, when people don't know what the average price dividend ratio is going to be, it doesn't forecast reliably. So it can be true that prices are driven by variation in expected returns, but you can't use that fact to time the market because you cannot forecast. And one last point. At best, it's a very long frequency thing. It is not high prices mean you're going to lose money tomorrow, and low prices mean you're going to make money tomorrow. At best, what we're talking about is the variation over the 10-year, 15-year, even longer cycles of risk-taking. When you bought in 1934, it didn't come back until 1950. So these are very long cycles we're talking about, not the foundation for a hedge fund and a trading strategy and so forth. So just to summarize quickly, just because prices are driven by variations in risk and risk premium doesn't mean you can use that in real time to make useful forecasts of long-term returns. Sorry.
Too bad. I hope you were going to give me the magic formula for asset allocation starting from that.
Magic formula, well, we'll get to there. Ask me the magic formula for asset allocation. I'll give you an even longer answer.
Now I can start my hedge fund out of it.
Well, yeah. A hedge fund, which is, you're borrowing and making risky investments, and you got to show performance on an annual basis. This is not the anomaly on which to start your hedge fund, because, as every value manager knows, we're great over 10-year, 20-year horizons, but the market can be irrational longer than you can be solvent, I think is the
and if you have clients,
the joke.
It's even worse because you have to tell them every year how it's going.
Well, you have to educate your clients. Value and similar strategies, which we're talking about. Your client needs to understand the difference between alpha and arbitrage. And flipping a coin that's 55-45 versus I'm going to make money every year for sure. And 1 year of bad performance doesn't mean flipping a 55-45 coin is a bad idea. That takes real client education, and most clients tend to be hot money.
The practical question, starting from the idea of the forecastability of future returns, is can we use this information to implement a dynamic asset allocation, at least from a risk management perspective? I mean, if I start, for example, from the classic Merton share, I should invest a portion of my wealth according to the proportion between the expected returns and the risk I'm going to bear from both an objective point of view, the variance, and a subjective point of view, which is called gamma, my risk aversion coefficient. Can I say that in an environment with a very high valuation level, I would be better off from a risk management point of view to reduce, for example, my exposure to risky assets and the other way around if we were in a 2009 environment?
2009 is when we wanted to go back and increase our allocation to risky assets. That's difficult. And let's start with if you're selling, who's buying? So I think all asset allocation decisions need to start with the theorem that the average investor holds the market portfolio without even rebalancing. This is just a fact. The average investor holds the market portfolio, right? So that anything that you do that differs, you overweight stocks, you underweight stocks, for example, somebody else has to take the other side of that bet. And it's a zero-sum game relative to just holding the market portfolio. So I think that benchmark, we need to start with that benchmark always. If you're buying, who's selling? Now, most people say, well, I'm smarter than average, and the other guy's dumb. Well, half of those people are wrong. Are you sure you're not the one who's wrong? Oh, maybe. So I think that perspective is the place you start from. Now, that does not mean that we all sit and hold the market portfolio. I think it means in order to do something different, you need to identify why is the market moving the way it is, and how are you different than everybody else? How are you able to take that risk in response to a good return? Let's say it's March 2009. It's not an obvious you ought to buy because the market is low because somebody's selling. Somebody is really in danger. And that person should not be selling money. If you're a typical stockholder in that case, you're typically a person who owns a small to medium-sized company, leveraged, and it's a big recession on. And even though the expected returns are high, there is still risk. It could get worse before it gets better. And there's still the risk that your business shuts down, in this recession. So that's a typical person who is selling despite a great opportunity. So any advice that is given to everybody is bad advice because, for everybody who's buying, there has to be somebody who's selling. And that guy who's owning that company, that's on the verge, should not be loading up on stock market risk, even though the opportunity is great. So to wind around to slowly answering your question, I think the right way to put that is to examine why do you think prices are high versus low? Is it a variation in risk and risk tolerance? Or is it this time everybody knows that AI is going to come and offer huge profits or whatever the story is? Second, am I better or worse than the average person to take the risk, the corresponding to whatever the opportunity is? And the answer should be half the time no. The person who's selling to me should be selling to me, and I'm buying because I should be buying. But if we were in each other's shoes, we should be turning the other way around. So I think about let's think about the economic fundamentals of who you are and who should be taking equity market risk before we jump into, well, I'm smarter than everybody else.
Do you believe that individual investors with a very long-term horizon can have an edge on that since they can take the other side of a trade? Because, for example, there's a lot of big institutional investors that cannot really bear so much risk. They have to sell at some point, although they know that sticking with their position would be better because they have clients, because they have regulations, and so on and so forth. For example, in the aftermath of April the 2nd, Liberation Day, we discovered that hedge funds were net sellers while retail investors were net buyers. Because, buy the dip, YOLO, etc. But they knew they can bear a risk that hedge funds cannot.
Right. And this is, I think this is also just not opinion. There's, papers doing this stuff. What are the implications of time-varying expected returns for portfolios? If you work it out mathematically, there's two implications. The first is the one you're going to, that you should dynamically change your asset allocation. If you are not exposed to the time-varying risk or risk aversion that is driving the phenomenon, then you should be the one who sells when it's high and buys when it's low. Now, if everybody was like that, the phenomenon wouldn't happen. If everybody was the mean variance investor with no outside income risk, no time-varying risk aversion, then price dividend ratios, then the expected return would be constant. So somebody out there is driving this phenomenon and should not be following this advice. But we calculate advice for the mean variance investor, the one last person who is not driving this phenomenon. And it's, first thing is buy more when it's low, sell more when it's high. Again, there must be somebody out there for which the proper advice is do exactly the opposite. Otherwise, this whole thing wouldn't happen. But I think the part that's undersold is the one that you're starting to get. Long-term investors should just hold higher levels of equity than short-term investors without trying to market time. The market timing is difficult in real time, but the phenomenon is there. So what is the implication of what I said is the truth, of what we know empirically? That expected returns vary over time. Price dividend ratios respond to those, but it's very difficult to know, is this time different than other times? It's very difficult to forecast without knowing the long-term mean. Well, the implication of that is that long-term investors should hold more equities, but you should be very careful about how much of this market timing you do, because that's much less certain. So let me expand on that. Long-term investors, if you're really long-term, now a lot of people say they're the long-term investor and they don't mean it.
Yeah, 5-year long-term horizon.
Yeah. So I mean, an investor who has like a 10-year, 20-year horizon. What you want is the income steady, supporting your beautiful lifestyle of Ferraris on Lake Como or whatever it is for the next 20 years, not just trying to appeal to an Italian audience. Let's take the risk-averse long-term investor. What's the risk-free asset for somebody like that? Now, this is a great puzzle I give to my MBA class.
I would cheat because I read the paper.
The risk-free asset is not cash. It's not overnight debt. The risk-free asset is a long-term indexed bond, even though the price of that thing wanders all over the place. Why? Because every time the price goes down, the yield goes up. I think that's where we started. And the coupons that get paid are absolutely steady. So you can afford the mechanics bill on that Ferrari every year when it comes due, and the rent on your villa on Lake Como. Okay, so the risk-free asset for a long-term investor is an indexed perpetuity, a long-term index bond. That's mind-blowing. Similarly, that same investor, when he wants to take some risk, is much better placed to take equity risk because he can ignore the prices going up and down relative to dividends and earnings and just basically eat the dividends and earnings, which are better over the long run than bond coupons. Now, you have to really be a long-term investor. If you bought that index perpetuity and interest rates go up and the price goes down and your husband or wife says, "What are you doing, you moron?" I said, "Buy something risk-free," and it went down. We need to sell it all now. You're not really a long-term investor. And if you're selling management services, can you really explain to your clients who are long-term investors, "Oh, we lost 30% of your portfolio, but don't worry, yields are going up. You'll make it back in the long run." You better have a very well-educated client to understand that buying long-term bonds was the right thing to do and to rip up the statements when they come in and ignore them. So are you really a long-term investor? Can you sit there while the mark-to-market value of your portfolio shrinks and say, "Well, it's okay because I understand, that this is a temporary fluctuation. I'm not going to bail out now. I'm not going to fire my investment manager. I'm not going to sell everything to something." University endowments said proudly on their website, "We're the long-term investor. We never care." 2008 came, they were all selling in a panic. So much for the long-term investor. So look deep in your heart. Are you really the long-term investor? Can you afford mark-to-market losses? You won't panic. You really do want to live off. Then you should have an unconditional allocation to equities that is higher than the short-term investor.
Well, I suppose it all comes down to the fact that most investors cannot really be long-term investors all the time. That's the reason why stocks maintain their risk premium. Otherwise, if we all knew for sure that in the long run stocks are safe despite their short-term volatility, the risk premium would disappear. If we all are certain that it's not risky to invest in stocks in the long run, then there wouldn't be any risk to sustain, so the premium will likely disappear.
The risk premium will be less, but it will not disappear. The risk premium remain. So price earnings ratios come back to some long run mean that itself changes over time. So the low R star could disappear. All sorts of bad things could happen. But in the end, the total return is the price earnings ratio times the growth in earnings. So the long run risk of stocks is very real, and it is the long run risk of economic growth. And so you are taking the risk that the economy does better or worse. And long run growth is not guaranteed. I'm sorry, look at Italy, where long run growth stopped in 2010. And things could get worse. They cannot. So there still is there should be a substantial equity premium because you're taking that risk of long run economic growth that you are not taking if you have default free indexed perpetuities. Now, whether our governments will default is another risk. I mean, even those are not risk free, but the hypothetical risk free index perpetuity is still safer than a broadly diversified portfolio of stocks.
There's a mounting discussion about lower future returns going forward. And the typical argument is starting from 1981, interest rates declined in a pretty straight line up until they reached zero in 2020, 2021. And so valuations grew more than profits, at least in the US. Therefore, the idea is that we somehow have borrowed from future returns. The last 40 years, exceptional returns have somewhat borrowed from future returns. Do you think this argument has any ground?
Oh, yeah, sure. So first of all, make sure you're looking at real interest rates, not nominal interest rates. But real interest rates did decline from 1980 until a couple of years ago, 2000. Price dividend is 1 over R minus G, right? So R goes down, price dividend ratio goes up. And there's two components to the R. There's the equity premium and the risk-free rate. And both the equity premium and the risk-free rate, I think, arguably went down with this long historical trend from 1980 till now. Now, will that go on? Will it reverse? I find it hard to think we'll continue on a trend into negative 3, 4, 5, so forth interest rates. Nobody really knows why that happens. Well, lots of people think they know, but I don't think anybody really knows. There's plenty of stories. So as we stopped having babies, there are more middle-aged people saving. So that, more middle-aged people saving puts downward pressure on rates of return. But those middle-aged people are turning into old people who now want to sell. So that, we talk about demographics, that should turn around. Sort of the safety of conquering the business cycle and inflation, that kind of all exploded. So who knows about that? These savings glut from China or whatever, now we're off with totally non-economic answers. But, that the Chinese have, I think, woken up and they don't want to keep working so hard to put stuff on boats and take pieces of paper in return onto which we are going to inflate away pretty quickly. So that's not a new force. So that low and real interest rate trend, the answer to your question is yes, of course. They trend down in real interest rates, raises stock valuations. And in the sense, yeah, you borrowed the returns from the future. When prices are low, when prices are high, yields are low. When yields are low, prices are high. Any way you want to try to explain that to your students, I usually spend about an hour and a half on that one. It is right. But things could change. And now, on the other hand, so if what happens in the future is expected returns rise, either interest rates rise or risk premiums rise, then the prices will fall sharply. You'll get your returns back after a big capital loss. And I think there's reasons to think that fundamentally the rate of return is the marginal product of capital. There's two big economic. What drives the rate of return? So let's look at supply and let's look at demand. On the supply end, it's the marginal product of capital. Are there investments where you can put your money and they know how to do something with it that produces a real profit, right? That in the end, that's got to matter. There was some sense we were running out of ideas and running out of things to do, but maybe AI, biotech, I think it's all these great things. If only, especially in Europe, you could get the permits to do it. So the potential for huge growth, marginal product of capital is there, but so is the potential for our governments to stymie it and the after-tax, after-regulation marginal product of capital to stay in the doldrums. On the consumer end, the rate of return is the discount rate plus something related to the rate of economic growth. Higher economic growth raises the rate of return, and that's all a wonderful and good thing. Higher economic growth, higher marginal product of capital, greater increase in technology, that raises rates of return. But when the news comes, the price plummets today when it raises the rate of return. So sorry. On some things, not on other things. On things that you need, the price, like NVIDIA chips, the price goes up until we get in. So that's kind of the big thing. And I went on a little bit because I do think it's important. in investing to understand what are the economic forces, or to recognize you don't understand what the economic forces are, and you might as well just hold the market like everybody else.
Yeah, the macroeconomic picture doesn't seem to be set for a lot of optimism, because we have a lot of headwinds like higher inflation, huge debt in most of the developed countries, and demographic stagnation, and just one tailwind, the artificial intelligence. The only one thing that could boost growth at an abnormal rate. It seems an uneven balance and not a very optimistic one looking forward. What do you think?
I'm more of an optimist. So there's the macroeconomic conditions where we think about business cycles and so forth. To our long-run investor, that kind of comes, kind of goes. There's some market timing, yes, but over 3 or 4 years, it goes away. Then there's sort of financial cycles, which are more important to our investing. And, the serious recessions have all involved something going wrong in finance. So something could go wrong in finance, and you better not be too leveraged when that something goes wrong in finance. There's all sorts of great long-run ideas that fall to pieces when you realize, I got to post collateral in the worst possible state of the world. So make sure you can survive the financial things going on. And then there's where's the future? Now, there is this AI thing. I actually kind of worry AI is a little overhyped, and especially overhyped for investors in the obvious companies. Remember, of course, how Netscape, Yahoo, and AOL Time Warner have all this internet thing completely sewn up, don't they now? That didn't work so well. That AI is going to be really important? Yes, that the companies who now have AI and stratospheric valuations are going to be able to deliver profits for their investors to make sense of those stratospheric valuations much less clear. But there's all sorts of other stuff going on. And then there's just sort of the basics. In Europe, I think, is regulated to death. And the Draghi report at least came out and said out loud, we're regulated to death. Now, Draghi said we need to borrow a ton of money and throw it down 1,500 rat holes in order to solve that problem, which, maybe isn't the best solution to the problem. But some regulation and some recognition in Europe that, you can grow. You don't need AI to grow in Europe. Europe is 40% poorer than the U.S. And let me tell you, the U.S. economy is pretty darn dysfunctional. Well, you can grow 40% just by, having regulations only as dysfunctional as U.S. regulations instead of regulations as dysfunctional as Brussels regulations. So there's a lot of room for great economic growth just in the mundane, get our economies going again sorts of things. And I think there's a growing recognition that this is important in Europe as well as the U.S. And on the left the right actually is kind of abandoning good old-fashioned economics. What is this trade war business about? That's a big headwind. But the left in the U.S. has discovered, we want windmills, and it takes 10 years to get the permits to connect the windmill to the grid. Something's wrong with that. We want houses, but it takes 15 years to get the permit to build a house. Something's wrong with that. So that's where I think, real growth does not just come from the snazzy idea that grabs the headline and GameStop, there's a wonderful idea. Real growth comes from just the regular business of getting the sand out of the gears. And it's a political question whether our political systems will allow real growth to break out. But I think the potential is there.
As you probably know, in Europe, we have over-regulations and no political unity, and this is highly consequential for future growth. It was evident these days during negotiations with the United States. It's difficult to come up with Germans want one thing, the French other things, Italians other things, and so on and so forth. It's very difficult to achieve a sustainable growth with too many hats, too many regulations, no fiscal union, not to mention political union, and without an integrated market that attracts capitals. The solutions are there, and Mario Draghi was straightforward about it. The implementation side worries me a bit more.
Let me, if I could, I'd like to put in a plug for, I just finished a book with two co-authors, Luis Caricano and Klaus Masu, called Crisis Cycle on how to fix the euro.
Great.
So, and it's remarkably cheap, only $35. So
we'll put it in the descriptions below.
That part of European of affairs. But I don't know how to fix. It does not talk about how to fix the other regulatory problems and the union problems. Europe is, I thought it was going to be fantastic. All of a sudden you have a integrated market and you're going to be the United States of Europe. You should be growing like crazy. The tragedy of Europe is, why are you not growing like crazy? Well, it turns out that integrated market isn't as integrated as you think, and there's still national regulators, and Brussels kind of adds on to the national regulators and makes everything more difficult. So I hope the time for reform comes to Europe.
In December, when I met Gene Fama, I asked him what he thought about tariffs, and back then we didn't know what was going to happen. Nonetheless, he said, not good, not a good one. Now we're all trying to figure out the implications of this sudden change in global trade, because we were accustomed to free trade for 80 years, and now we have to think in a new framework without globalization, without free trade. Most economists think it's a bad thing, and I don't really manage to come up with a sort of unified interpretation that makes sense of it. Could you please help us to figure out the economic rationale behind it?
There is none.
Oh, great.
I mean, there's lots of. There's 10, which tells you there's none. Tariffs in the U.S. are an answer in search of a question. And that you can see that because when you say, why do you have tariffs? They give you 10 reasons that are mutually inconsistent with each other. Oh, we want to force everybody else to lower their tariffs. Oh, we want to bring manufacturing back to the U.S. so that U.S. workers who today work like this on us, can spend their days screwing in an iPhone.
Memorable quote from Lutnick. Yeah.
Oh, we're national security. He said this is like 50. When there's 10 different questions that always the same, the answer is the same, and the questions change. You know that there's nothing sensible behind it. Now let me, I got to try to be not too much of an economist. Tariffs are costly to the country. Aircraft carriers are costly to the country. So there is an argument, very narrow on national security grounds, that some trade restrictions might make sense, but that doesn't explain, what. So why is steel from Europe a national security problem? Why are cars from Europe a national security problem? It makes no sense. That's an example of there is a reason. There's another, there's an optimal tariff theory that says you should raise tariffs if you have market power to screw your enemies, to screw your friends. Is the point of the U.S. really to screw our friends? If we want to make Americans better off at the expense of Mexicans, why don't we just send the Marines in to take their stuff? Well, if you don't want to do that, then, that argument for tariffs explodes. So there are arguments for tariffs, but none of them, I think, make sense of what's going on. There's, every now and then, politicians and parties they support sort of get bad ideas in their heads. And we've seen plenty of that from the left. Rent control, there's a bad idea, and it continues to be popular, destroying one city after another. Now, I think that is a little bit of good news. Something without an economic reason can't last that long. And certainly, President Trump is attuned to his economic reputation. And, when markets tank, he backs off quickly. So I hope we'll come to some equilibrium. In the U.S., also, the method of imposing tariffs looks to me pretty darn illegal. The president cannot simply say, I want 50% tariffs on Brazil, on your morning coffee, and get away with it. Our legal system is quite good, but it takes a long time. So I think this is a big danger. The last thing I'll say about tariffs, remember, the damage of a tax is proportional to the square of the tax rate. So a small tariff, while annoying to economists, a 10% tariff. Well, we have a 10% sales tax in California. You got a 25% VAT in Italy. So, another 10% isn't going to kill it. It's not good. It's a very inefficient tax, doesn't help anything, but it's not the end of the world. 100% tariffs are, much, much more damaging. And, and the uncertainty about it. I think there is an effect that people aren't making big capital investments because they don't know what the tariff regime is going to look like when that comes off. So, overall not good, but not the end of the world so far.
Do you have a clue about why on April the 3rd, the markets crashed upon the reciprocal tariffs were disclosed? And now markets are at all-time high with tariffs still close to that level.
Well, why do markets go up and down? We always know the day after, right? And we never know the day before. I think that, markets do look at the long run. And I don't think a long-run equilibrium where the U.S. cuts itself off from world trade with enormous tariffs is sustainable. And I think markets understand that. And Trump does, he makes a big noise, but then he does eventually back down. So I think they're betting that we will not have a long run with very high tariffs. It's just so economically damaging. It's hard to see how that could happen. So the greed won out over fear on that one.
Do you think the general consensus is that tariffs are not here to stay?
I think unfortunately, small tariffs are here to stay because they are, tariffs are a classic one where there's a small group that benefits a lot and a large group that costs a little bit. And they can run to Washington. Once you open the door, they can run and get their tariffs. And then they are very, very hard to get rid of one at a time. That's why, for 50 years, we all worked together to say we're going to get rid of tariffs. And because the optimal economic policy is unilateral free trade. So why don't we just do that? Why are our trade agreements 10,000 pages long? Well, Italy, I don't know if you protect your pasta makers, but you probably do. And, so the Italian politician says, look, I know, importing pasta from the U.S. would make sense, but, the pasta makers are after me. So, right. I have to be part of a rule where I can go to the pasta maker and say, look, I'm sorry, there's some larger thing I'm forced. I can't give you the thing you want. But once you're negotiating country by country and good by good, it's very difficult to get rid of. And also, for a politician, arbitrary tariffs are wonderful because every industry, you can say to Canto, you want to get rid of the tariff? You want more tariffs on podcasts? Get rid of those American podcasts that are ruining employment in the Italian podcast. That's nice. Tell me, where were you at the last campaign fundraiser? I didn't see you at the rally. You didn't write an op-ed very nice to the administration last year, did you? So when tariffs always come in with, negotiated exemptions, so they're wonderful for politicians. So it's a great deal on both sides for milking the taxpayer. And that's why, moving to a system of arbitrary tariffs imposed by the administration under executive order without even the legal procedures we had for our previous tariffs is it's going to be hard to get rid of once it goes in. So I think we're fated for another long time to get rid of this thing.
Yeah, very insightful. Thank you. Trump's victory in the last elections seems a sort of general reaction against the former, let's call it, mainstream policies that, for example, led to an increase in government indebtedness and other traditional policies. In the same way that, for example, the interest in crypto has grown along the last 15 years, mainly among people disappointed with the way money policy has been managed by governments. There seems to be a silver lining between the two. I was wondering if you see a connection between growing interest in Bitcoin, cryptocurrencies, stable coins, etc., and the voters' need for political disruption.
So a couple of answers to that. I want to push back on your assertion that Trump's election was a repudiation of mainstream and traditional economic policies that produced a lot of debt. Trump's election was a reaction against the, maybe they're mainstream in Europe, but the complete failure of the progressive left in the U.S. and the kind of crazy economic policies that they were enacting and including the abject incompetence that we saw, for example, during COVID. Our public health authorities, the lockdowns, the masks, you had it in Italy. I remember the hilarious video of the mayor going out after people's dogs and asking, what's wrong with these dogs with prostate problems? But what's the government doing, telling you can't, take your dog out? That all turned out to be silly. That all turned out to, we gave them our trust, but it turned out they were, completely incompetent. It was a reaction against inflation more than debt. Now, because Trump is certainly not in there on reduce the debt, reduce the deficit. That is, and he didn't say he was going to do that, and he's absolutely not doing that. So I think those policies, what you're calling mainstream, it might be mainstream at Davos, but the mainstream at Davos was just not working, and people could see it. Cities were falling apart in the U.S. Our immigration system was completely out of control. I'm all for lots of immigration, but not the way it was being done. So it was a repudiation of the sort of incompetent policies that were falling apart in many ways. Now, Trump has actually done a lot of great things. We're not going to commit energy suicide like Europe is planning to commit energy suicide. That's pretty good for our growth. There's one executive order right there. We're not going to regulate AI out of existence like Europe has regulated AI out of existence.
Europe's motto is regulate first, then think about it.
Exactly. So there's a lot of, good stuff going on. And then there's the tariffs and a lot of great news. So that was just the background. You asked about crypto. Yeah, crypto did arise out of a libertarian view that we need some alternative to the dollar. It is something technologically new, but not something financially new. So Bitcoin is just a fiat currency without backing. And we discovered fiat currencies without backing can be pretty darn volatile. And good luck to it. It's also not particularly efficient. Now, I see stable coins are very interesting. That is nothing new financially. It's a reinvention of the narrow bank. Well, there's two kinds of stable. There's stable coins that ain't so stable, ones that are backed by air and promises and Bitcoin and something else. That's a reinvention of the 19th century bank, which we know how that worked out. Then there's the stable coin backed by Treasury securities, which is a reinvention of the Federal Money Market Fund with slightly different technology. That could have a great purpose, but is no longer a different numeraire, a different unit of account. It's no longer separated from the dollar and the euro as the sort of libertarian fantasy. But Bitcoin was this libertarian fantasy of what do we do when the governments all fall apart, default on all their debts, hyperinflation ravages the land, but the computers still work. We'll see how that goes. And a lot of what stablecoins are doing, now they are finally legal. There's a little more clarification. But it's interesting, they seem to be one more financial innovation that's just getting around the ill-conceived regulations of other financial regulations. Why do we not have a money market fund, which is a stablecoin, that allows instant transactions? Why can't I have a debit card that is a claim on an institution that holds short-term government debt and nothing else and allows me low-cost transactions? Well, because the big banks don't allow it. And in Europe, the ECB, the digital euro project, you're only allowed to have 3,000 euros, and otherwise you got to go back to a bank. Gee, I wonder why. Well, the banks really want your money. So a lot of what, it is, what's the purpose of it? A lot of it is a purpose around ill-conceived regulations. It would be a lot better to fix the regulations. But, that's in some sense, that's good. So, technical innovation to get around ill-conceived regulations is always a useful thing.
Very recently, Gene Fama was on Zingale's podcast, Capitalism, and he claimed that he thinks Bitcoin value will eventually go to zero. Do you think he's right on it?
I'm a little less. It is a fiat money. It's not backed. So we can just apply the theory of money that we've understood for 300 years on the value of that thing. Now there is value to fiat monies. It's a liquidity value if it's useful for making transactions, right? And if it's in limited supply, then money can continue to have a value. And Bitcoin is useful for making illegal transactions. And by the way, that's not, we don't necessarily want to enforce every single law. If we enforced every law about who can work in both Italy and in the US, the economy would fall apart instantly. If we collected every tax, the economy would fall apart instantly. We're kind of at a happy medium between enforcement and actually having the economy work. And I don't want to enforce the laws, China's currency laws. I think we should undermine China's currency law to the point that Bitcoin is great for undermining China's currency laws and Venezuela's capital controls and getting money into Ukraine. Great. So there is a transactions demand. There's also transactions demand. It's wonderful for scammers, hackers, drug cartels. It moves money around cheap. So you get a fiat currency. It can have value as long as there's a transactions demand. That's the good side, but it needs a limited supply. Now, Bitcoin itself has a limited supply. You waste a lot of computer cycles factoring immense prime numbers. What is it, like half the energy of Iceland is being devoted to factoring its prime numbers. Okay. There's that proof of work limit. But the real Achilles heel is there's nothing that stops you from making substitutes. You can fork Bitcoin itself. You can create 150 other coins, and you can create stable coins that don't have the volatility. So that seems to me, and here's where I agree with you, over the long run, when substitutes can be created, when you can create derivative accounts, when you can create the 19th century bank that invests in Bitcoin and therefore leverage up the Bitcoin, I think the supply of such things can grow. There's no limit on the supply, and that would eventually undermine its use. But things that have a convenience yield, the liquidity demand, can have very high values for a surprisingly long amount of time.
Yeah, very interesting. Professor, last question before we part each other. I wish to close the circle by coming back to investing. If you were speaking to a 20, 30-year-old today with no particular background in finance, what is the one principle about investing you would want her to understand?
Oh, I can't give you just one.
Besides reading asset pricing.
Well, actually, reading asset pricing is good for understanding markets and for becoming a researcher. It was designed for people who want to become researchers in finance, not people who want to become investors. I'll advertise. I have a paper called Portfolios for Long-Term Investors on my website. If you want to read one thing and you're an investor, I think that summarizes what I've learned from academic research. And I would say, of course, ignore the obvious. So do not start with the search for the magic alpha. Let's start with the basics. Diversify. You want a broad-based portfolio. Invest. If you're 30, you want to invest in equities. Now, understand you're bearing a risk, the risk of long-term economic growth. But save to start with. Pay off your credit cards. Don't have any personal debt. Invest in equities. Invest in a low-cost, passively managed, diversified portfolio of equities. Don't pay taxes you don't have to pay. Here's free magic alpha. I don't know the Italian tax code, but in the U.S., short-term capital gains are taxed a lot more than long-term capital gains. Never take a short-term capital gain. So, not paying taxes you don't have to pay is an easy one. And there's increasingly tax managed. That's not a zero-sum game. That's we can all pay less taxes. So broad diversification, more equities than the average person is holding. Actually save. Don't pay taxes you don't have to pay, and only then start worrying about all the fun stuff, the magic alpha, the factors. I guess I would add diversification includes your own personal portfolio. So don't invest everything in your own company, because when the company goes under and you lose your job, you'll also lose your portfolio. Even if you think your company is fantastic, it's really risky to invest in your own company. It's really risky to invest in your own industry. Don't diversify away from your personal. And that's part of, if you're going to not hold the market, you're going to start thinking about, how am I different from other people? I'm different because I work in, I should not invest in universities. I love universities because, I lose my job, I lose the university. So that diversification is part of that thinking. If you're going to do anything different, think about, how am I different from the average investor? So understand the average investor theorem, understand that fees usually don't pay for themselves unless, you got to be better than the other person. The average earnings, the average fee is just paid. Maybe there's a good one, maybe there's a bad one. If you're going to do something different, you have to be better than the average person at doing something, either picking stocks or picking managers. You can't just go in. There's no magic freedom. So that goes last on the list. Invert the list. I guess the one piece of advice I see is invert the usual list.
With holiday time coming, I highly suggest the 42-page paper Portfolios for Long-Term Investors, where you can find clues about the average investor theory, which is illuminating about how to think about our own portfolio. Professor Cochrane, thank you so much. It was really amazing to host you. I'd have 100 more questions, but I will spare them for another time. It was a real honor to have you here.
It's been a great pleasure, and I'll come back and we can do some of those other 100 questions.
Great. Bye-bye.
Bye-bye.
And that's all, folks. I hope you enjoyed the episode and that it helped shed some light where there's often a lot of shadow when it comes to understanding what really drives market movements and what that means for investor decision-making. I can't thank Professor Cochrane enough for his generosity and openness, and I truly look forward to having him back with us soon to continue this important conversation. A heartfelt thank you to all of you as well who continue to follow me with such moving loyalty, even under the August sun during the final month in which the bull will be, well, just as you've known it for the past 2+ years. Because starting September the 1st, stay tuned, big news is coming. In the meantime, don't forget to hit follow and turn on notifications on Spotify, Apple Podcast, YouTube, or wherever you are listening. And if you can, please leave a 5-star review to support us and help us keep bringing you fresh content with the world's most brilliant minds in financial research. But that's really all for this episode, and I catch you again next Wednesday for another appointment, right here, of course, with The Bull, your personal finance podcast.